higher rent costs were a big contributor to today's CPI report, with shelter making up the primary chunk in the rise in consumer prices. Joining us now to talk about that and the big moves we've seen in rates in the last week is Ryan Williams, founder and executive chairman of Cadre, a commercial real estate investment platform. Ryan, good to see you. So this bank situation and interest rates, how is it complicating an already tricky environment with high rates in commercial real estate?
Yeah, thank you, John. It's good to be with you. Look, I think that what's happening at this point in time is, you're really starting to see a barbell effect. You're starting to see some clear winners and losers from an asset class and sector perspective. There's no more, rising tide lifts all boats. Thematic investing is no longer in vogue, and instead, you have to be a specialized sharpshooter in order to really find opportunity. Office as an overall sector is incredibly challenged, and we're just beginning to see some of that stress arise. And I would bet that you see a lot more distress beginning to play out in that space. Meanwhile, in multifamily, multifamily rents are incredibly attractive from an affordability perspective versus single family, given where rates are. So you have these interesting barbell effects that are only being exacerbated by the interest rate and inflationary environment.
Okay, I keep hearing that multifamily and industrial are better, stronger bets right now versus office. But we just had this news from Meta, Mark Zuckerberg saying, I want people in the office again. Productivity is important. So are there pockets of recovery in office? Are you finding any opportunities out there?
Yeah, absolutely. I'm in my office right now. So and we got a lot of folks here as well, too. We are seeing some recovery in office and frankly, some stability and consistency to us. And when we're thinking about investing, it's all about quality and a flight to quality. And I do think that office assets that offer unique amenities, where you have landlords who are investing heavily, are going to be resilient. And the flip side, Class B office assets, older office buildings where, you might have been able to see higher rents because you were in New York or San Francisco, are seeing extreme stress and distress, even with some of the largest owners of real estate giving back the keys at this stage. And I think, again, we're just beginning to see the tip of the iceberg for those lower quality assets. But for higher quality, there's nothing like being in person. And I think those buildings will continue to outsize growth.
Ryan, I want to go back to multifamily for a minute, since you are heavily invested there. The rent prices that we saw on CPI this morning, we know that those numbers tend to be very outdated by the time they make it into that monthly print. What are you seeing at your properties in terms of rents? Are prices actually starting to come down right now?
Yeah, we're absolutely seeing a muted level of growth across our multifamily properties. We're not seeing declines, but we are seeing that instead of a 5%, 6%, 7% type annual year-over-year rent growth, we're closer to 2% to 3%. And we're seeing 25 to 50 basis points of decline really every quarter over the last few quarters in terms of growth. And our view is multifamily is an incredibly defensive asset class. I don't think we'll start seeing any declines, but I do think that the days of double-digit type growth projections are over.